Assalamualaikum and hi. Today we are going to present our group assignment about capital structure and dividend policy. Before we dive into the topic, I would like to introduce our team members. First, we have Muhammad Nur Muhaimin bin Zaini, Vishnu Naidu anak lelaki Apla Naidu, Muhammad Ibtisam bin Ibrahim, Nur Hidayah Arifah binti Muhammad Azam, and lastly, me, Suhaini binti Roslin. Our objective of our group assignment is first, able to define and apply the concept of capital structure and dividend policy. Second, describe how public banks make decisions regarding their capital structure and dividend policy and what current practices are they employing to optimize their financial performance. Third, explain the factors that influence public bank choice of capital structure and how have recent economic conditions affected this decision. Next, explain how do public banks decide on their dividend policies and what factors do they consider when determining how much to pay out to shareholders. Lastly, explain how do public banks balance their need for growth and investment with their obligation to pay dividend to shareholders. We have chosen public bank as our research topic for our group assignment. And public bank was founded in 1966 by the late Tan Sri Datuk Sri Dr. Teh Hung Pyo. On 6 August 1966, public bank started their business and their first branch was located at Jalan Gereja, Kuala Lumpur. With their vision as a bank for the people, public bank started providing banking service to the masses in Malaysia. On 6 April 1967, public bank was listed on Bursa Malaysia. Public bank has expanded the banking business to include comprehensive suite of financial products and services, which consists of personal banking, commercial banking, Islamic banking, and investment banking. To serve customer better, the group leverage on the advancement of technology and digital capabilities in line with the evolving needs of customers. With its resilient business model, the group has maintained a track record of unbroken profitability for 56 consecutive years. The group is highly reputed for its stellar performance, especially in sustaining the highest return on equity, maintaining the most efficient cost-to-income ratio, and the best asset quality among domestic banks. The group remains a market leader in several major business segments, including customer banking, retail commercial, banking for small and medium enterprises, and as well as private unit trusts. Capital structure refers to the way a company finances its operation and growth by using different sources of funds. The main components of capital structure are debt, equity, and hybrid instruments. Debt includes loans, bonds, and other forms of borrowing. Debt financing requires the company to pay interest and repay the principal amount over time. But debt can be advantageous because of interest payments are tax deductible, reducing the company's tax burden. However, if the company has too much debt, it will increase the financial risk and the possibility of bankruptcy. Next, equity includes common and preferred stock issued to the investor in exchange for ownership in the company. Equity financing does not need regular interest payment, but it reduces the ownership share of current shareholders. Equity investors seek return through dividend and capital gains. Last but not least, some financial instruments like convertible bond and preferred shares combine features of both debt and equity. Choosing between debt and equity is a balancing act. A well-crafted mix helps lower costs and boost shareholder value. Factors like company's financial health, market condition, interest rate, management comfort with risk, growth potential, and tax rule all play a part in this decision. It's like finding the right blend of ingredients for a recipe. Each element matters and can affect the final outcome. The advantages of capital structure is interest is tax deductible. This can lower the overall cost of running a business. Second, selling shares avoid repayment. Raising money by selling shares doesn't require regular payment, which can be a big relief for managing cash flow. Next, capital structure allows the owners to retain full control and ownership of the company since the lenders do not getting vote rights. Last but not least, selling shares can bring in significant fund that doesn't need to be repaid, making it easier to invest in growth and expansion projects without financial stress. However, capital structure also brings some disadvantages. First, it raises the risk of bankruptcy. High level of debt increase financial risk and the potential of bankruptcy if the company cannot meet its obligation. Second, although it's less risky in terms of repayment, it does mean giving up some control of the company to new shareholders. Next, it comes with the baggage of interest rates and the risk of financial distress. Last but not least, requires sharing profits with a larger group of shareholders, which can reduce the earning per share for existing shareholders.
Now, let's focus on the analysis of the capital structure, highlighting 4 key financial metrics that demonstrate the company's performance and financial stability. First one, earning per share. This metric measures the company's ability to provide higher returns to shareholders. As shown in the chart, there is a noticeable increase in EPS from 2022 to 2023, indicating improved profitability. Second one is return on asset. Return on asset reflects the bank's efficiency in utilizing its asset to generate earnings. While the value remains low, there is slight progress from 2022 to 2023. Third one is the return on equity. This indicates how effectively the bank utilizes shareholders' equity to generate profits. We see steady improvement in ROE over the 2 years, showcasing enhanced efficiency in equity utilization. The last one is the Common Equity Tier 1 ratio. This is a critical measure of the bank's financial strength and stability. The CET1 ratio remains consistent between the 2 years, which is essential for maintaining trust and operational security. Overall, the chart provides a visual representation of growth and stability in these metrics, emphasizing the company's positive trajectory.
Dividend policy. Dividend policy refers to the strategy a company uses to decide how much of its earnings will be distributed to the shareholders in the form of dividends and how much will be retained for reinvestment in the business. Key aspects of the dividend policy including regular dividend, special dividend, dividend reinvestment plan, DRIPs, and retained earnings. Regular dividend is where company may pay regular, predictable dividend at fixed interval, for example, quarterly or annually. Regular dividends provide a steady income stream for shareholders and signal financial stability. Next, special dividends are one-time distribution that companies may pay in addition to regular dividends. Apart from that, special dividends are usually declared when a company has excess cash or has received extraordinary profits. Dividend reinvestment plans DRIPs is where some companies offer shareholders the option to reinvest their dividends in additional shares of the company's stock instead of receiving cash payment. Retained earnings is the portion of profits not paid out as dividends is retained for reinvestment in the company. Retained earnings can be used for purposes such as funding new projects, expanding operation, or paying off debt. Dividend policy decisions are influenced by several factors, including the company's profitability and cash flow, investment opportunities and growth prospects, holder preference for income versus capital gain, market condition and economic outlook, also regulatory and tax consideration. A company's dividend policy can have significant implications for investor perception and stock valuation. Investors often view consistent and increasing dividend as a sign of financial health and confidence in the future earnings. The advantages of dividend policy is, first, paying regular dividend can attract investors who love steady income streams. It sends a positive message to the market that the company is doing well and is confident about its future. Dividends are a way to give shareholders a direct return on their investment, which can boost their satisfaction and loyalty. Companies can avoid the pressure to reinvest all profit, allowing them to make more strategic decisions. Stabilize the company's stock price by offering a predictable return that can be reassuring during uncertain market conditions. However, dividend policy also brings some disadvantages. Paying out dividends means there is less money left for reinvesting in the business. Companies that focus on high dividend payout might miss out on investing in projects that could drive long-term growth. Dividends can be taxed twice, first when the company makes a profit and again when the shareholder receives their dividend income. Dividend policy also require plenty of cash reserve, which can be tough especially during economic downturns. Limits a company's flexibility to adapt financially when market conditions change. Investors expect them to continue or even increase. This can put pressure on the company, especially during tough times.
Let's move on to the analysis of dividend policy. As you know, dividend policy is a plan that shows how a company shares its profit with the shareholder. It is an important part of building trust and maintain a good relationship with the investor. Public member has shown strong financial results which allow them to increase their dividend payout for this current year. For the most recent period, the total dividend was 90 cents per share. This is equal to Rm 2.7 million ringgit paid to the shareholder. The bank paid its first interim dividend on September 22, 2023. The second interim dividend has already been declared for 2024. What is important is the dividend have been grown compared to the previous year. This is showing their commitment to reward shareholders and reflecting their financial stability. Next, let's look at the financial performance of the public member head. First of all, financial performance analysis of public member head that I focused on was financial stability, profitability, cash flow, operational efficiency, strategic investment. The numbers show that the bank is performing well and is financially stable. Public member head has been able to grow its profit consistently over the years. This is important because it means that the bank is well managed and able to handle a challenge in the market. The strong financial performance also support the bank's ability to pay higher dividend to a shareholder. It shows that they can balance growth, profitability, and sustainability. The financial performance by focusing on growth and stability of the company.
Recommendation capital structure, debt to equity ratio, sound financial position, capital ratio 14.7%, total capital ratio 17.6%, ample room for additional debt without risking creditworthiness, financial flexibility, adequate equity and share result. resilience during downturns and funds strategic initiative, leverage high CASA ratio as a reliable low-cost funding base, balancing debt and equity, use Tier 2 debt or hybrid capital instrument to lower the cost of capital, maintain equity to support strong return on equity and financial resilience, close monitoring of debt to protect liquidity and asset quality, especially in violates condition. And lastly, optimum debt to equity ratio, target ratio 2 to 1 to balance lower financing costs and tax benefit of debt, enhance liquidity and support growth in high margin lending sector. Recommendation dividend policy, stable dividend policy. First one, income focused investor. Most of the investor in public bank Berhad are income focused and prefer a regular dividend payout over potential capital gains. Then, consistency and predictable. Public bank Berhad has reassured their shareholder of steady returns. Third point, historical performance. Public bank Berhad has a historical of consistent dividend payment, which demonstrate their ability to generate stable earning and maintain a strong financial position. The fourth one, market stability. Regular dividend payment can contribute to market stability. This method can attract long-term investors and enhance public bank reputation in the financial market. And lastly, balancing growth and return. Public bank Berhad focus on growth and expansion. They also ensure that their shareholder benefit from the success through regular dividend that can help to maintain investor satisfaction and loyalty. Long-term strategy, shareholders return. Public bank Berhad has a strong record of payout shareholders return. They can continue to offer those dividends while ensuring a portion of profit to be reinvested into public bank Berhad for their future growth. Sustainable practice. By maintaining sustainable practice, public bank Berhad can increase their reputation and attract more investors. Public bank Berhad has aimed to mobilize 100 billion ringgit in sustainable finance by 2013. And lastly, cost efficiency. Maintaining cost efficiency is crucial. Public bank has already positioned itself as the most cost efficient bank in Malaysia, with a cost of income ratio of 33.7% compared to the industry average of 48.3%.
Now, let's move to the research question. How public bank makes decision regarding their capital structure and dividend policy? I'll also highlight the current practices they use to optimize their financial performance. To make this decision, public banks evaluate several critical factors. First one is cost of capital. They assess the expense of obtaining financing, whether through debt or equity. Next one is financial flexibility. Maintaining flexibility ensures the bank can respond to unexpected opportunities or challenges. Next one is market conditions. Economic trends such as interest rates and inflation play a significant role. Next, shareholder expectation. Banks aim to align their strategy with shareholder demands for returns, balancing debt and equity. They strive to find the optimal mix to maximize financial performance while minimizing risk. This structured approach helps public banks to achieve a sustainable and effective capital structure. Public banks have also adopted specific practices to optimize their financial performance. First one is maintaining a conservative approach to debt levels. By keeping debt manageable, banks ensure stability in uncertain economic times. The next one is investing in digital transformation. This supports efficiency and innovation, which are critical in today's competitive bank environment. The next one is managing capital structure effectively. Banks focus on maintaining robust capital adequacy ratios, ensuring they have sufficient reserves, providing steady dividends. Meeting shareholder expectation with consistent dividend payments fosters investor confidence. These practices allows public bank to maintain financial resilience and adapt to an evolving market dynamics. In summary, public banks carefully evaluate a range of factors when making decisions about their capital structure and dividend policy. By implementing thoughtful strategies and maintaining robust practice, they continue to optimize their financial performance. Now, let's move to the next research question. What factors influence a public bank's choice of capital structure, and how have the recent economic condition impact this decision? We will also look at the example of companies that have adjusted their capital structure to respond to changing market conditions. Let's begin by discussing the factors that influence a public bank's capital structure. The first one is interest rates. Lower interest rates encourage borrowing, while higher rates can deter it. Next one is risk profile. Banks must balance between debt and equity based on their risk tolerance. The next one is growth potential. Companies with strong growth prospect may favor external financing to fund expansion. And the last one is industry norms. Established practice in the banking sector guide capital structure decisions. These elements guide how banks maintain a mix of debt and equity to meet their financial objectives. Now, let's consider the impact of recent economic conditions. Rising interest rates and inflation have pushed banks to reduce their reliance on debt. This trend helps mitigate the risk of higher borrowing costs, making capital structure adjustment critical for financial stability. Finally, let's look at an example of how companies are adapting. Apple Inc., as shown in the slide, has streamlined its capital structure by increasing share buybacks and issuing bonds during periods of low interest rates. This strategy has helped Apple optimize its financial while providing strong returns to shareholders. This example highlights how companies proactively adjust their strategies in response to market conditions. In summary, public banks consider several factors such as interest rate, risk, growth potential, and industry norm when shaping their capital structure. Recent economic conditions like inflation and higher interest rates have influenced this decision significantly. Learning from companies like Apple, we see how strategic capital adjustment can ensure financial resilience.
Next, let's look into the third research question on how do public banks decide on their dividend policies and what factors do they consider when determining how much to pay out to the shareholders. And we are also required to provide examples of companies that have recently changed their dividend policies and what drove them to take these decisions. Companies set their dividend policies by considering factors such as profitability, cash flow stability, growth opportunities, and shareholders' preferences. Public Bank Berhad follows a stable dividend policy, balancing shareholder returns while retaining earnings for investment. This decision-making is influenced by the bank's profitability, cash flow, and commitment to maintaining shareholder trust, as well as external factors like market volatility and regulatory changes. For instance, during the COVID-19 pandemic, Petronas Dagangan Berhad reduced its dividend payments to 66% to conserve cash and ensure liquidity, showcasing how companies adjust their policies in response to economic challenges. Other examples also include Shell in 2023. They increased dividend by 15% because of high profits, and Maybank in 2023 pay out high dividend ratio of 77.4% because of strong profit and larger operations, and Intel in 2023 cut down their dividend by 65% because of weak earnings and challenging market. Next, the fourth and final research question aims at how companies balance their need for growth and investment with their obligation to pay dividends to shareholders. To balance growth and dividends, companies like Public Bank Berhad structure their capital to finance expansion while providing adequate returns to shareholders. Public Bank Berhad achieves this by maintaining a conservative dividend payout ratio and reinvesting retained earnings into high-growth projects. This strategy supports strategic initiatives and ensures consistent dividends, highlighting the bank's commitment to both growth and shareholder satisfaction. Similarly, Maybank Berhad also adopts a balanced approach by maintaining a prudent dividend payout ratio and reinvesting earnings into digital banking and new market opportunities. This allows Maybank to pursue innovation and expansion while still delivering reliable dividends to shareholders. By focusing on sustainable growth and financial stability, both Public Bank Berhad and Maybank Berhad demonstrate how companies can effectively balance immediate return with long-term investment. This approach not only ensures long-term shareholder satisfaction but also enhances the bank's competitiveness in a dynamic economic environment. Through strategic capital allocation and disciplined financial management, these banks position themselves for sustained success and resilience. In conclusion, this whole report aims to explore key aspects of public banks, capital structure and dividend policy while answering to 4 research questions that we have already presented. These 4 research questions delve into how companies make decisions regarding their capital structure and dividend policy. And the analysis that we have already done in this report investigates how companies balance growth and investment with their obligation to pay dividend. That is all from our group. Thank you for listening to our analysis to Public Bank Berhad.